The IASB Conceptual Framework for Financial Reporting provides the theoretical foundation upon which International Financial Reporting Standards, IFRS accounting standards, are developed. Rather than prescribing detailed accounting treatments, it establishes a coherent system of objectives and principles that guide the recognition, measurement, presentation, and disclosure of financial information. The framework aims to ensure that financial statements provide information that is useful to existing and potential investors, lenders, and other creditors in making economic decisions. It serves as a reference point for standard setters, preparers, auditors, and users when dealing with transactions not specifically addressed by IFRS standards. A conceptual framework can therefore be defined as a structured set of interrelated concepts and fundamental principles governing financial reporting. It promotes consistency, comparability, and logical development of accounting standards by ensuring that individual standards are based upon common objectives rather than isolated responses to emerging issues. The framework itself is not an accounting standard and cannot override IFRS requirements, but it provides authoritative guidance whenever explicit standards are absent or permit alternative accounting treatments. The necessity of a conceptual framework arises from the complexity and evolving nature of modern business transactions. Without such a framework, accounting standards would likely develop through an ad hoc, firefighting approach, resulting in inconsistencies and conflicting treatments across standards. A conceptual framework reduces opportunities for political influence and lobbying by ensuring that standards reflect objective accounting principles rather than industry-specific interests. It also strengthens the credibility of financial reporting by providing a transparent theoretical basis for accounting decisions. The principal alternative is a rules-based accounting system, exemplified historically by U.S. GAAP, which relies on detailed prescriptions and specific guidance for numerous transactions. A rules-based approach offers advantages such as greater precision, enhanced comparability, and reduced ambiguity in application. However, it may encourage box-ticking compliance and allow entities to exploit technical loopholes while failing to reflect economic substance. In contrast, the IASB's principles-based framework encourages professional judgment and economic realism, making it more adaptable to innovative transactions and less susceptible to manipulation. Consequently, many jurisdictions increasingly favor conceptual principles supported by detailed standards where necessary. Central to the framework are the fundamental qualitative characteristics of useful financial information: relevance and faithful representation. Relevance means that information is capable of influencing users' economic decisions. Information possesses relevance when it has predictive value, enabling users to forecast future outcomes, and confirmatory value, helping users evaluate previous expectations. Materiality is an entity-specific aspect of relevance. Information is material if its omission, misstatement, or obscuring could influence users' decisions. Consequently, immaterial information need not be disclosed, whereas material information must be reported regardless of size if its nature makes it significant. Faithful representation requires financial information to reflect the underlying economic substance of transactions rather than merely their legal form. A perfectly faithful representation possesses three characteristics: completeness, providing all information necessary for understanding; neutrality, free from bias or deliberate manipulation; freedom from error, meaning information is prepared using appropriate processes and estimates without material inaccuracies. Importantly, freedom from error does not imply perfect precision, but rather that estimates and assumptions are appropriately described and applied. Faithful representation extends beyond simple compliance with IFRS standards. An entity may technically comply with IFRS while structuring transactions to obscure their economic reality. The framework therefore emphasizes substance over form, requiring accountants to ensure that financial statements faithfully portray the economic consequences of transactions. Professional judgment remains essential in achieving high-quality reporting, particularly where estimation uncertainty or complex financial instruments are involved. The framework also identifies four enhancing qualitative characteristics that improve the usefulness of relevant and faithfully represented information. Comparability enables users to identify similarities and differences across entities and reporting periods. Consistent accounting policies and transparent disclosure facilitate meaningful comparisons. Verifiability provides assurance that information faithfully represents economic phenomena through independent observation or recalculation. Timeliness ensures that information is available early enough to influence decision-making, recognizing that outdated information rapidly loses relevance. Understandability requires information to be presented clearly and logically for users possessing reasonable business and accounting knowledge. Comparability is particularly important when accounting policies change. IAS 8 accounting policies, Changes in accounting estimates and errors requires retrospective application of voluntary accounting policy changes wherever practicable, together with restatement of comparative figures and adequate disclosure. Such treatment preserves consistency across reporting periods, enabling users to distinguish genuine economic changes from changes arising solely from accounting methodology. Overall, the IASB conceptual framework establishes the intellectual foundation of IFRS financial reporting by promoting decision-useful information through the principles of relevance, faithful representation, comparability, verifiability, timeliness, and understandability. These characteristics collectively enhance the quality, transparency, and credibility of financial statements in global capital markets.